Where are you from?
Well, I used to work for Virgin Green Fund.
Gotcha.
Now I work for the EBRD venture capital practice. So EBRD indeed does direct investments into companies, technology companies, venture capital investments. If you want to learn more about what do we do in direct equity investments in technology companies, VC stage, here's the URL, please check it out. But basically the thing that I wanted to talk about, and I realize this is the last agenda point on the agenda, point, is kind of, we VCs, we always talk about adding value. And usually it is in the form of the, besides the capital, it is in the form of advice, mentorship, connections, which I think all make sense, and it all kind of sounds similar among the investors. But I think there is a fundamental point that also needs to be taken into account, of which we do not talk often. And maybe it's too basic that we do not talk often, but I think it is really fundamental, and without that, you cannot talk about adding value. And I also think that this point is specifically very relevant for venture capital markets which are less developed, because we see that this point is really kind of sometimes misunderstood or omitted in the venture capital markets which are less developed. So basically, in a nutshell, is the relationship, what that point is, the relationship between the venture capital investors and the entrepreneurs needs to be based on the deep empathy. It needs to be based on the understanding of the needs of the entrepreneur. And venture capitalists, we, in essence, my view, we're service providers to entrepreneurs. As much as you need to understand the needs of your customers, we have to understand your needs. And that's how I see the relationship being developed. How is it? Okay, so let's first ask kind of question. One question is, I think it's very relevant. Do venture capitalists add value at all? And I think there are, besides the capital invested, and I think there are kind of two views which are both well qualified, and those views kind of two extreme views. One is the National Venture Capital Association in the US, which basically says that venture capitalists, they do much more than provide capital to entrepreneurs. They also help companies grow via providing advice, and they improve the performance. That's one view. Another view, great practitioner of this asset class, Vinod Khosla, partner of the Kleiner Perkins and co-founder of Sun. So on one of the interviews, he mentioned that he believes a percentage higher than 95%. You can guess what is a percentage higher than 95%. Adds zero value to companies. And percentage somewhere 70 to 80% of venture capital investors actually add negative value. So kind of two there is a big gap between the two. My view, again, everything what I say is kind of my personal view, is obviously it depends. The answer is always easy, it depends. Now, when we see the returns, venture capital returns, and if we kind of take returns as a benchmark, whether the VCs add value or not, which arguably may not be the best benchmark, you can see that some investors, select investors, they do generate positive returns. And usually, statistically, what the returns show us that the track record is the best indication whether venture capitalist is generating value for the investors, value for the portfolio companies. Track record is the best indication. So basically, this implies that there are certain proprietary systems, brand, procedures, and culture that generate recurring success for venture capital investors in their portfolio companies. And I want to talk today specifically about the latter part, the culture of generating, helping the companies, generating returns for the investors and working together with entrepreneurs on that. But why do we talk about the proprietary systems? How can the systems be proprietary? How can the processes be proprietary? How can the culture be proprietary? Because if you look at the website of every VC is the same. Basically, all the VC website says that they provide capital, right? They advise and mentor companies across three main areas: strategic, operational, financing. They help with their network of relationships, talent network, customer network, financing network, and we do have great brand and visibility to create more publicity for our portfolio companies. So kind of every VC would tell you that most often, and that's how the kind of marketing materials looks in terms of the websites and other. But we do believe that there are different kind of venture capitalists. They have different cultures, different approaches, and I think it is important for you to really understand who is the right investor for you, and try to kind of mutually select the one that makes more sense in your circumstances. So let's just see what are the kind of three typical types of investors. So one is operator. So operator type of venture capitalist is basically most often it is he or she kind of the investor would have structured process to add value. It usually will be in the form of the standardized services via operational support teams. And usually those standardized services are recruitment, online marketing, performance-based online marketing, and product development. So very hands-on approach, helping companies. That usually works very well at the early stage when the idea needs to be proven, where the product market fit needs to be established. And that usually works kind of, if it works, usually the investors are back with the more capital to invest. One thing though you need to watch out is that there is a risk that such an investor will get too much involved in the daily operations of the business, stepping up with the kind of performing management role. But that model today is very kind of, I would say, very popular. One example, probably Anders Hovis. I understand they have a very big teams across those support functions, and they can provide a lot of help in different functions that the company needs to undertake. Now, another approach is a mentor-based approach. This is probably where most kind of VCs position themselves. So it's based really on unstructured interaction between the investor and the entrepreneur. And the value usually here provided by sharing the experience and sharing the network, be it the customer network, a financing network, or talent network. This is usually kind of the best, I would say, type of investor for A to C classes. And in terms of the kind of the things that you need to watch out is that you really need to be relevant for such an investor, because usually those investors, they have big portfolio companies, and as long as you have a potential to generate return at the portfolio level, that would kind of usually reflect the investor involvement. And the last type of investor I would call financier. We see that a lot, especially in the emerging markets, where the focus is on investing the right amount of capital at the right state and at the right valuation. So very much financial engineering driven approach. The relationship with entrepreneurs most often is very structured, and it's based on the legal rights, as opposed to interpersonal relationship. And kind of investors really focus on the generating kind of near-term or medium-term exit. I mean, obviously, kind of one thing that you may want to watch out with such kind of investors is that such investors may distract you with obsession of the financial engineering. I just wanted to quickly go through. We talked about what are the main functions that VC performs, kind of how just some of the examples how it may work out well those functions and how it may not. So if we talk about providing capital, providing financing capital, the important point obviously is every dollar that you do not raise, every dollar that you do not spend is a dollar that you do not raise, and it is an important to kind of get the company adequately financed. So kind of what you want to achieve, you want to raise enough capital to reach key value milestones, while also understand that most often you underestimate your financing needs. Sometimes how this process can actually damage you is that if you raise too much capital, some of the investors, they basically may argue that you need to raise more capital, and this can be explained that they have strategies in terms of minimum ownership level or minimum amount of capital that they provide, and overcapitalize the business. The danger of this, obviously, that when you have too much capital, you lose your focus. Also, often enough, because we focus on the really large upside, on the home run opportunities, we like to push you hard, expanding and growing fast. But at the same time, you probably do not want to do that before you establish the key customer proposition. The key customer proposition before you kind of define and deliver key customer value. Example, if you have a very high churn in your core product, it means that there is something, something wrong with it, may mean something wrong with the product. That maybe something needs to be addressed, improving the product itself before probably pushing with geographical expansion and raising more capital in the proposition which is not proven. Now, advise and mentor companies, this is kind of the core function of the VCs, right? And but argue that kind of the most fundamental and the most basic function that VCs, in my mind, needs to perform, and that's often not talked enough, or basically precondition for any value addition, is this kind of. It is supporting founder vision, supporting founder culture, and supporting founder focus, keeping naysayers away, right? Entrepreneurship is a very lonely process, even in a team environment, and as a venture capital investor, I believe the best thing that we can do, and the real precondition for us to get involved, is really buy into the company, into the founder vision. Next one is helping companies and teams to recruit, not hire, but to recruit talent. And this is the core function of the VC. And I would think as well is that when you speak to the VCs, what you may want to make sure is that those investors, they would really get your vision. Can they sell that vision to their network? Can they help you hire the right people? When things go wrong, right, or things go not entirely to the plan, which happens all the time, the best that we as investors can do is strengthen the team. Strengthen the team with the kind of more execution experience, as opposed for us to get involved. And I do believe the best way for a venture capitalist to be involved is to share experience. Share experience, share stories, and ask the right questions. So that's kind of the positive approach. On some of the negatives that you need to be aware of, they happen sometimes when advising and mentoring companies, is that some VCs, especially those kind of often that have been CEOs themselves in the past, they try to do the job themselves for the management. kind of deeply involving into the company operations and not taking any blame for the outcomes of their involvement, right? This is a problem, right? Because kind of, if as a venture capital investor, if you are too deeply involved, if you need to get involved on a daily operations of the business, it means one of the two things, right? Either you are not the right investor, or the management team is not right? One of the two. But it cannot be right that as a venture capital investor, basically, as an investor who supports the vision of entrepreneurs, you would get involved on the daily running of the business. The other also kind of sometimes happen is that when investors hire management teams, investors' function is to recruit. CEO function is to hire. And while it is indeed it does help the company to bring in new management teams at some point in time with a lot more execution experience, that focus at the earliest stages on the changing the management team usually creates disruption, which results most of the time in the company failure. Other things that happen so often kind of with the investors who focus on the financial more kind of financial engineers, they love talks about M&A, even at the early stages, where they kind of at that point in time, the best time spent for a company is improving the operations of the business. And lastly, what you need to realize that any board, which is kind of any investment is usually done by a consortium of investors, and this consortium is represented by a number of investors on the board of directors, and all of them, they have their own businesses to run, right? All of them, they have their own agendas, and they, one example can be fund life. So you would need to pay attention to what are the drivers behind what are the drivers on the investor side business that may disrupt your business. So in terms of the network of relationships, it's a very simple. Everybody talks about network of talent, customers, financing, acquirers, that we want to help you do that. It is indeed very important to do so, and we all do that. However, and this is a kind of very naive point, make sure that your investors deliver on that, right? Sometimes what may happen is that people promise but never act. And the best way to do that, the best way to make sure that that investor would help you is to do reference calls. Calling to the companies that investors have already invested, asking them questions. Anytime when we get to a term sheet stage with the companies that we invest, and a company founder asks me, what can you do to me in different areas, I tell them, look, I can tell you anything, but the best thing, I will send you a spreadsheet which shows all the companies that we have invested and the mobile numbers for the founders. And the best thing for you to do is actually to call as many as you can and ask questions directly from them as opposed to from me. Now, obviously a lot of entrepreneurs are enchanted by big VC brands. Which is kind of often right, because as we spoke about that the track record is the best indication of the VC ability to add value to portfolio companies and also generate positive returns for its investors. But at the same time, you need to realize that that brand only matters if it works for your purposes. The brand needs to work, the venture capital brand publicity needs to work for the portfolio company purposes, not the other way around. So, in a nutshell, how can you be confident that this investor is right for you? How can you kind of establish a good long-term relationship, which it needs to be? My kind of point is very basic, but probably a bit subtle. Is investors add, in my view, most value when they share the passion with entrepreneurs. When you talk to your investors, really it is a mutual selection process. You really need to understand what their passion for a vision. Do they spend more time discussing the cash flow forecast statement, which most often doesn't make much sense in the early stage business, or do they spend time doing product demo? Do they spend time understanding how you win your customers? Do they meet the key people in the company? Are they as well excited about your team as you are? I think this is the best kind of indication. And finally, and as I mentioned, it is a mutual selection process. Not all companies are venture capital backable. It is a very specific asset class. And some entrepreneurs are actually best not raising venture capital. Some of them are. And those who are, obviously this is a long-term relationship. Do as much due diligence as you can. And it is indeed a mutual selection process. It is more difficult in some of the markets of Eastern Europe, where there is less capital. But I think there is no excuse of not doing your work on your side, not doing your selection work, because since it is such a long relationship, it will definitely backfire. That's pretty much all from me. Thank you.
All right, thank you very much, Bakhrom. We do have time for a couple of questions, if you're okay with that.
Sure.
Anybody who's sitting on the question? All right. So one thing, I'd like you to reflect a little bit more on this. I totally agree on the based on the mutual understanding of where we're going. The empathy is important in the relationship. The problem is that most of the founders that I've seen that pitched me came in sort of desperation. So no matter where we took the conversation, they'll be like, yeah, because they're already, pissed their pants a little bit. They're already in that much of a need of the funding. Mm-hmm. And going forward with that, you don't want to make your investors too, reluctant in terms of you asking too many questions, blah blah blah. What are the best questions to ask in that process then? Like, how open can you be about, that, you're in a situation where you actually need this investment very very soon. They open up for a chance for you, then being pressured in the negotiation and so on.
I think I think it is best to be as open as possible, and it is really you mentioned that a lot of the entrepreneurs, they change their line of conversation to be led by the investor. But I think for the investor side, this is actually a sign of weakness, right? What you want to show is that I think the key for the startup companies is actually setting the priorities for themselves and focusing on the priorities. As a startup business, you can do a lot of stuff at any point in time, but what you actually do and what you don't do, it is extremely important. And basically showing the clear vision, clear focus on the fundamental of the business, I think it always reflects best for investors.
So what are the best questions to ask? Like, what are two or three best questions that a founder can ask you when you're in the negotiation?
Well, I guess one is obviously it is pretty much the case with all the companies that things don't go on the plan, right? And there are obviously stages of the good growth and stages of the when things are failing. And one thing to understand is how the investor acts at those cases. And the best way actually to do that again is not to talk about it to investor, but do reference calls. Do reference calls with the portfolio companies of those investors.
All right, great. Any last minute questions? Doesn't seem to be the case. All right. That was very, very insightful. Thank you so much. Give a big round of applause for Bakhrom.